Hey everyone, welcome. Today we're going to break down something that's at the very heart of investing, the relationship between risk and return. We're going to demystify the core principles that really determine the price of, well, just about anything you can invest in.
It's the million-dollar question, right? How do you actually get a great return on your money without, losing your shirt in the process? This is the central puzzle that every investor faces, and today we're going to piece it together.
All right, let's dive right in. The thing is, every single investment decision you ever make or ever will make boils down to this one fundamental trade-off.
Look, it's simple. We all want those juicy, high returns. But, and it's a big but, that almost always means you're taking on more uncertainty, more risk. So the real question becomes, is there any way to manage that risk without giving up on potential gains?
Well, it turns out there is. There's a powerful technique, something finance folks call the only free lunch in investing. It's a way you can actually cut down your risk without lowering your expected returns. Sounds too good to be true, right? Well, let's see how it works.
Okay, so check this out. We've got two different stocks here, A and B. What's interesting is they both have the exact same expected return, $11, and they're both equally jumpy, equally volatile. We measure that with a number called variance, and for both of them it's 4.
But here's where the magic happens. Look what happens when we combine them into a single portfolio. We put half our money in stock A, half in stock B. Our expected return? Still $11. We haven't lost anything there. But look at the variance. The overall risk of our portfolio has been sliced right in half. It's down to 2.
And that right there is the big idea. By spreading your investments around, not putting all your eggs in one basket, you can get rid of a very specific kind of risk for free. You get the same potential reward for a whole lot less potential heartburn. So this really breaks down the two kinds of risk you face. There's non-systematic risk. That's the stuff that's unique to a single company, like a bad product launch or a scandal. Diversification basically makes that risk, poof, disappear. But what's left over is systematic risk. This is the big stuff that hits the entire market. Think interest rate hikes or recessions. You can't get rid of this one. And here's the key. It's the only risk you actually get paid to take.
Okay, so if we're stuck with this systematic market-wide risk, how do we actually measure it for a specific asset? That's our next stop.
The tool we use is a nifty little metric called beta. All beta does is tell us how much a stock tends to zig or zag when the entire market zigs or zags. It's how we put a number on that systematic risk we just can't escape.
And this chart makes it super easy to see. By definition, the market as a whole has a beta of exactly 1. A really stable, maybe even kind of boring stock like a utility company, it might have a beta of 0.5. It's only half as volatile as the market. But on the other end, you've got a high-flying tech stock. Its beta could be 2.0, meaning it's twice as volatile.
So what does that actually mean? Well, if a stock has a beta of 2.0, you'd expect it to jump up 2% every time the market goes up 1%. But on the flip side, you'd also expect it to drop 2% if the market drops 1%. Beta gives us a real hard number for that risk we get paid to take.
All right, here we go. This is the big payoff. We've figured out which risk actually matters, the systematic kind, and we've even learned how to measure it with beta. So the billion-dollar question is, how much extra return should we demand for taking on that specific amount of risk?
The answer comes from a really elegant idea called the Capital Asset Pricing Model, or CAP for short. And we can build it in 3 pretty logical steps. First, you start with your baseline, the risk-free rate. Think of it as the return you could get on something super safe, like a government bond. Then you add the rewards you get just for being in the stock market at all. That's called the market risk premium. And finally, you take that market reward and you adjust it based on your specific asset's beta.
And this is what it looks like all put together. Your expected return is that safe, risk-free rate plus the stock's beta multiplied by that extra kick the market gives you. It's this beautiful, simple formula that connects risk and return directly.
Now, it's only fair to mention, this model works in a perfect world, right? It assumes things like no trading fees and that everyone has the same information at the same time. The real world is obviously a bit messier, but CAPM gives us an incredibly powerful way to think about things.
So, this all leads to the ultimate question for any investor. If a model like CAPM can tell us what a stock should be earning, does that mean we can find stocks that are on sale and actually beat the market?
Well, hold on, because CAPM isn't the only theory out there. There's another one called arbitrage pricing theory. It suggests that it's not just the overall market that drives returns.
It says other big economic factors, like GDP growth or inflation, also play a huge role.
But maybe the biggest challenge to the whole idea of beating the market comes from something called the efficient market hypothesis. This is a huge idea. It basically says that in a fast-moving, competitive market, all the information out there is already reflected in a stock's current price. If that's true, then there are no bargains to be found.
And this theory actually comes in 3 different strengths. Weak form says you can't win just by looking at old price charts. Semi-strong form goes further and says that even if you dig through all the public financial reports, you won't get an edge. And then there's strong form, the most extreme, which says that even if you had a legal insider info, you still couldn't consistently win. Pretty wild.
Which brings us right back to the core debate in all of finance. If markets really are efficient, is a successful stock picker just skillful, or are they just lucky? Thinking about this question gets to the very heart of how you should invest. Do you hunt for those hidden gems, or do you just buy the whole market and ride the wave? It's the central question that shapes everything.